Hello and welcome into the KE Report. Chad and Corey here as your hosts, and we're talking with our friend and colleague Erik Wetterling. Erik runs thehedgelesshorseman.com, and we will put a link to that down below in the show notes so you can follow along with the companies on Erik's radar, some of the videos he puts out to the market. And Erik, it's a red day as we talk here in the markets on Monday, the 27th, and we see gold down 3%, we see silver down 4%. A lot of the junior mining stocks related equities are down double that or triple that. Some of them down high single digits, even some companies down double digits. So it seems like a sentiment move where you have a washout in the buying strength and a lot more sellers than buyers. As things correct down, we were just talking about some of the mismatches that start showing up in valuations and just common sense that if there's a 3 to 4% move in the metals, should a stock really be down 12% or 15% on the day? But it talks about the leverage and the torque that these juniors have in both directions, both to the upside and the downside. So just curious to get your read, your lay of the land on some of the action we see to kick off this week.
Yeah, I mean, a lot of people watch today's action and they see it as evidence why, this sector is so bad, and why they hate this sector and all that. It's like, I mean, this is honestly the reason why I really love this sector, simply because, I mean, almost nothing makes any sense on a day-to-day basis. Because, I mean, take explorers, for example, what impact does it have on the long-term fundamental value of the company that gold prices, for example, are 3% lower than they were yesterday? I mean, it's absolutely pretty much totally irrelevant, because if they don't have much gold, then it doesn't matter. If they have gold or find gold, then it might matter in 10 years what the actual gold price is. So that makes absolutely no sense, which then, as you pointed out, I mean, it's sentiment. All of this is sentiment. It's like, look at what type of junior stocks, for example, are typically correcting the hardest in the last week or so. Well, typically the ones that went up the most. So the ones that went almost vertical over the last couple of months, they are the ones being sold off the most, is what I'm seeing at least. I mean, what does that tell you? Well, okay, should they have gone absolutely vertical? Maybe they should, because some stuff was really cheap, and even if it went up, probably was kind of cheap. But it doesn't really matter, because we know that most people are actually momentum players, and I mean, everybody's chasing the quick buck, and if it was up yesterday and up today, they think it's going to go up tomorrow, so then they buy. And now with the opposite is happening, where you have some down action, and of course nobody actually sells today because gold or silver prices are down. They're not selling their gold and silver juniors because metals are down today. They're not selling because they legitimately think, oh, the value of the companies actually went down 10% today. No, they're selling because they think somebody else is going to sell it lower tomorrow, sell the share price lower tomorrow. They don't care about value. Otherwise, again, you can't explain it in that way. If there's no news out for a company, how on earth would the fundamental value go down 10% in one day just because metal prices are a few percent lower than they were yesterday? I mean, none of that makes sense. So it just goes to show that, I mean, on a daily basis, there's nothing, whatsoever that's connecting the share prices to the actual fundamentals.
So, Erik, this is all about sentiment and all about a correction, at least right now, a correction in a bull market. So, look, a lot of these stocks, as you said, they went vertical. They outperformed to the upside recently, and they're providing that leverage to the downside. It's actually the action that you typically see in these underlying stocks because let's face it, we're talking about essentially penny stocks here, juniors almost across the board, but even the majors are selling off, and that lower price does impact the majors because they are producing gold. But since you deal so much in the junior space, and one thing we talk so much about is all the financings that were completed in the last really 6 months here, but even more so over summer. Curious your thoughts then on now with this correction and with a little bit of a sell off. Do you put more importance on the stocks that have raised money that are fully funded through the next year, if not couple years? And to that point, do you want them coming out with news right now with their drill program, or do you want them holding off until there might be some sort of rebound, or at least this correction runs its course?
Yeah, I mean, I think that's a good question. I do think, I mean, especially the worse the sentiment is, the cheaper the prices are. I mean, if you can buy all the future news releases of a company at, let's say, 10% lower today than yesterday, if they have cash, they can also produce said news releases without actually the next news release being we need to do a financing. So you're because I don't think the market gives a crap about any even positive news really from a company if it's more than 3 months out. So if you have 18 months runway, for example, that means you're today, for example, you can buy all those news releases 10% cheaper because they're not priced in, nobody cares, and today they're not the prices are going down on sentiment. Yeah, so I mean, what was the other part of the question? Sorry.
Do you want them holding off on news? It really was. Do you want them holding off on news? And do you now focus on companies that have already raised money?
And okay, that's also a good question. I mean, the interesting thing is that, as I think we discussed on K Report before, I mean, in a poor sentiment environment, you can invest like an insider, even if you're an outsider. So we've seen today, for example, Goliath Resources put out some really good holes, and they only reported, or they only have the assays for the gold portion. So those grades are the minimum the grades are going to be if you consider the AU equivalent grades. And I think actually the stock was up for a bit, but then it sold off. I mean, why? Did the news change? No, it's just, sentiment changes. So as a holder, and that's the thing where this sector really is rigged against you in poor sentiment and rigged for you in good sentiment as a holder is because, okay, if you put out news, which we saw a lot of in 2024, even if you knew that a junior was going to put out good news, and we're not talking like exceptionally, extremely good news, but like obviously good news and obviously positive relative to the then low market cap, which is quite common in a bear market, low prices. And it would have no real reaction to the upside. But if the news would have been bad, you would get maybe absolutely slaughtered. So that is extremely punishing in a sense as a holder because the odds of you taking risk and getting rewarded is very low when sentiment is poor. But at the same time, if you're a buyer or a watcher, or whatever you might be, because the market is still wrong if it doesn't, revalue a company at all because there's no sentiment. Sometimes you saw good news being put out in the bear market and there was barely any trading. So apparently nothing at all changed for the company, which is absolute bullshit, of course. But nobody dared to buy it higher, and there was no willing buyer. So that's the thing for me. For example, since I'm all in all the time, it's like if you have 20, so let's say you own 20 juniors, 10 of them release good news into poor sentiment, and let's say they have also more money beyond that, so they can actually put out positive news going forward. So 10 of them put out positive news, share price doesn't go up, actually goes down along the same downdraft as your other 10 juniors that didn't put out any positive news and didn't go up in value. I mean, all of a sudden, half of your holdings are better buys than the other half of your holdings because they put out news and didn't go up. So I guess that might be a way around the answer, but I would just say I don't really care that much. Yes, as a holder, I get punished in a sense because again, I don't really get that much reward for the risk I'm taking. But at the same time, if they put out the news and the price doesn't reflect that, then I can also be a buyer. So I can also jump on that, let's say, price to value dislocation. So I guess I'm kind of ambiguous or whatever the term is. I don't really care because the thing that punishes me as a holder, I can make use of it as a buyer.
Yeah, I think it's a good point, Eric, because you can make volatility your friend. You can jump into these things when they pull back because the company is putting out news that's actually adding value at the time that the market cap is shrinking in value. So you have a better risk reward setup in that scenario if you have dry powder to deploy. But it just brings up the question about how these stocks re-rate. We were talking before this and even before this call that some of these stocks went up on no news at all. But in the past, they may have put out good news that got sold off in the bear market, and they're just re-rating to catch up with that. So, how do you deal with the drag or the delay factor in the fact that some of these that are sold off in a bad sentiment market eventually will get a sudden re-rating higher when there's a better sentiment environment. So some of those re-ratings that we saw weren't just companies going up on no news, they were companies going up on the realization of old news.
Right. I mean, that's true. That's the thing, right? That first of all, the what's typically the most important thing in a news release is what it actually says about the next 10, for example. And we saw companies put out news, and it's like you could obviously tell that the project was getting better, that the resources were increasing and all that, but the market again didn't care. So they were just basically pissing against the wind. And all of a sudden, when sentiment changes, people are like, they think it looks cheap when price is going up. Then it's like it's rediscovering the fact that, oh, right, this company actually had value from the get-go. I mean, that's why I kind of like the second part of the Lassonde Curve in a sense, in which we talked a lot about, because if the market can ignore and not give a crap that gold is at $4,000 and you see this crap where it's like, oh, this something sells off a lot because gold is the lowest it's been in 3 weeks or something. And at the same time, I mean, if you're looking to go into production, it's like the sentiment has no effect on what the gold price is going to be when you go into production, and not the cost either. So it's like in the perfect scenario, you would have stuff that's like, oh, it's totally trading with the rest of the junior sector. Like, oh, we're going to ignore the fact that gold is where it is. And they're not, making any money anyway. But it's like, yeah, but they might be making money in 1 or 2 years from now or something. And again, that's typically the market doesn't care about that. And of course, that's the whole idea about the second part of the Lassonde curve, that it all of a sudden revalues the closer you get to actual cash flow. Well, that's never been worth more than today. And that's, I mean, one of few perfect examples how you can really punish the market in a way, because, I mean, worst case scenario, or what a lot of juniors get stuck in, is that they have no real way to monetize their project. They're not going to get acquired. They're not going to get into production. So for all intents and purposes, they could theoretically be stuck as a trading sardine. I mean, because there's nothing that really forces the market to price it fairly. And of course, that's why we also typically see takeover premiums. I mean, it's basically the acquirer saying that, hey, I mean, we're buying you because you have a good project, but still we think you were 40% off. We think it's worth 40% more than the market. So, I mean, that's kind of as close as you're going to get. But then it kind of comes back to, okay, share structure and backing, etc. Because if you have a tight stock, you're typically going to get more rewarded. I mean, they are more volatile in a sense. But I've seen actually, I mean, on the topic of stuff that's gone up, I mean, some should go up and should go up even more. I mean, they were not even overvalued when gold hit 4,400. But some stuff with, good share structures, they went up as well. And I think, I mean, there's a few units I actually think were overvalued that I saw out there, except for the known basket cases. But they still went up, and they shouldn't really go up. They should go down and stay down. But you never know if they're, good backing and all that, and have an easy time getting the share price up. You can create a bull pretty much just because you own all the stock and there's not a lot of float out there. I mean, now I'm going into other stuff.
Erik, let me ask you this then, because it's something we were talking about 3 weeks ago, before this correction happened. A lot of people were talking about how a correction was due, and we were pointing to a lot of stocks, as Chad said, that didn't even have news that were 3x, 4x, where they were just a few months before. And we were quite vocal saying you should be taking some profits, not bailing out of positions, but taking some profits so that you do have some powder dry. As you said, if you're fully invested and you see these lower prices, how do you take advantage of them if you don't have cash? You need to sell something. So what do you think about those people that are saying, we told you to take some profits? You could have had some cash in your account and still held a vast majority of your positions after you saw these stocks go vertical, especially the ones that didn't really make sense that were going vertical. They're simply riding that sentiment wave. But now we're sitting here saying these stocks, some of them are 20, 25% lower. But if you don't have the money to buy them, then what's the point in even watching them day to day?
Yes. What is the point of watching them every day? No, I'm not much of a sentiment trader or a beta trader myself, so I might not be the best person to ask. And since I've been fully invested since 2015, I mean, I ride this entire sector to the absolute top every time and to the absolute bottom every time. And I just try to buy more shares as soon as possible. I mean, I buy
So,
high,
Eric,
I
how
buy
do
low.
you buy these shares then? Because you keep talking about taking advantage of lower prices, but you keep saying you're fully invested. So I'm curious how you balance that out.
Yeah, I mean, that's value shuffling. Or, I mean, most days I don't buy anything. But still, it's like the mentality is that, I mean, you should obviously be buying if there's panic selling. I mean, there's no better reason to buy than when there's panic selling, because by default, that means it's irrational selling, people thinking that it's going to go get cheaper tomorrow. And that's why everybody sells the bottom, because I've never seen anybody sell a bottom in this sector pointing to, oh, I think these are overvalued. Never so far have I ever seen anybody justify their decision to sell doing that. And it's the same with today. I mean, if you ask someone, did they actually get this much cheaper? No. So until then, so it's like whenever I have money, I invest as long as I find something I think is cheap. And at the same time, because this sector is so volatile, I mean, you can have a stock price go down 10%, and you think, let's say, the fundamentals are absolutely unchanged. And for all you know, gold might be $5,000 in 2 years, even though gold went from 4,400 to $4,000 in the last 3 weeks. But you think it's going to go get to 5,000 anyway in 2 years. And by then, let's say you have a company you think will be in production. I mean, if you get a 10% discount on that, that might be, I don't know, an additional 44% future return in 2 years, which is like 2 years worth of return. So, I mean, I'm just sitting there. I'm trying to kind of predict the fundamentals of companies and what the news flow might be and what then the value might be. And then I react to the price swings in the market. And that's why I've talked a lot about, value shuffling. I mean, most days there's not much to do. I mean, some stuff is up 3%, some stuff is down 3%. And it's not like I have that accurate of a crystal ball that I know exactly what something is worth. But sometimes stuff get absolutely exaggerated, and it could be panic selling, and then you obviously want something to go down more than something else that you own, so you can value shuffle, or something you own doesn't go down at all for some reason, but some other stuff that you like equal as much is down 20%. I mean, at face value, it doesn't change anything, but if you're right, the future portfolio returns will drastically change. Like my previous example, if you have 20 names, they will go down 10%, but 10 went down on positive news. If you reshuffle that, that's not going to do anything right now to your portfolio, because your portfolio is down 10% because all the names went down 10%. But if you overweight in those 10 names that actually got better, and now you're expecting 250% from them instead of whatever 200% before the price dip and additional positive news. I mean, you're creating future returns just by taking advantage of a single panic sell day in the market, for example. So, I mean, that's not really dry powder per se, but it's still creating future dry powder or future portfolio performance.
Well, Eric, I think we'll wrap it up there on that note. Just there's a couple different ways to slice it as far as approaches. Some people did trim and buy, some people have to do value shuffling, as you say, and sell something that maybe didn't create value to buy something that created value but went down the same amount. So you have to kind of look like a hawk at your portfolio and also at your watch list to see, do you want to rotate from one stock to another? Do you want to initiate a new position into the weakness? Do you think there's a better value proposition being presented by the market in a company that does have catalyst and sold off, just like a stock that maybe didn't have catalyst but sold off the same amount? So a lot to digest here for people on these kind of days, but a good day to do a portfolio review, to remember what you own, why you own it. And if you want to get more thoughts from Erik, definitely click on the link below in the show notes. It takes you over to thehedgelesshorseman.com, and you can follow along with the companies on his radar, some of the news that's coming out to the market on those stocks, and his reactions to those in both written work and in video. So, Erik, always great having you on the show to get your hot take on what's going on in the resource stocks. And as always, looking forward to our next conversation.
Thanks, and the same to you guys. And as always, if I mention any companies, consider me biased.